Afternoon all. Hope you're enjoying this unique manager showcase Hidden Gems edition. You now join us for an introduction to Semper Capital Management's Total Return UCITS fund. My name is Bo Bolgen. I am a member of the UK-based distribution team, and today I'm joined by Greg Parsons, CEO of Semper Capital from the US. Hi, Greg.
Good morning, how are you? Or good afternoon.
Yeah, afternoon. I'm hearing you loud and clear, thankfully. So, this call is for professional investors and eligible counterparties only. Any views expressed in this communication are those of the fund manager and are subject to change without notice. They are not necessarily the views of Semper Capital and do not constitute investment advice. Your capital is at risk. Past performance is not a guide to future performance. So that's that out of the way. Look, I'm going to very quickly hand over to Greg because of the limited time and we have a bit to cover here. But Greg's going to give us an introduction to the Semper Total Return Fund, a bit of insight into US RMBS, that's retail mortgage-backed securities, which may be a new sector or fixed income sector that you may not have looked at before. And hopefully you're going to see and we'll talk through why you should be considering this sector and Semper Capital, the Total Return Fund, for an allocation from your fixed income bucket. As ever, I'm sure you've heard that on your Zoom toolbar, there is a question function as we work through the slides. If you do want to ask anything, please input them there and I will put them to Greg at the end of the presentation. So Greg, short and sweet from me, I'll hand over to you.
Thank you, Bob. If you could flip the slide. Well, good afternoon, everyone. Greg Parsons, CEO of Semper, on behalf of the entire Semper platform. We appreciate you guys finding some time to listen to what we think is quite a compelling opportunity set that exists today in specifically in the U.S. mortgage-backed securities market. We only have 20 minutes of presentation. We'll open up the questions at the end. We'll give a few minutes of backdrop on the firm. A lot of context on the sector and the opportunity, and then we'll close with some specifics around the fund and the offering that we've partnered with and been in market with LGBR coming on 3 years now in the UK. So just quick on the name Semper. Semper is Latin for the word always. Post-Princeton, I spent some time in the Marine Corps, and that really helped solidify my thoughts on service and thoughts on what, the culture and attitude and approach that I would bring to market and that Semper would bring to market when it comes to asset management. So certainly it's something that runs through the bedrock of our organization. Flip the slide. Next slide. Before I start a little bit about Semper, and there is, today in the mortgage-backed securities market, there is, we believe, some of the strongest, if not absolute value, certainly relative value within fixed income. And that story and the themes of value, frankly, are market-wide relative to mortgages. Certainly, we at Semper believe that we are an advantaged access point to that sector. But the story, the themes of value, the opportunity set really is in market. And it really breaks down across three strong elements of value. The first is in a diversified basket of mortgage-backed securities, you can drive an advantaged yield in what continues to be a low rate environment globally, right? Our particular product, relative to the top of the stack assets, has got loss adjusted yields ranging 4.5% to 5%, in a world where the US 10-year is trading, anywhere 1.6 to 1.7, right? So for folks who are looking for solutions that have advantaged yield or income, it's our perspective, the market's perspective, that direct exposure to the mortgage-backed securities landscape can provide that. The second clunk is we're able to offer that yield with very low sensitivity to rates. And we've got some slides that take that statement and show the math behind it and show performance historically. But it's a sector that trades with very little sensitivity to rates. So for those that have a perspective that, at least again in the US, the general trend of rates will be up over the coming years, it's great defensive posturing relative to rates. And last, it's a sector due to the nature of its bet, right? Its specific tie to the US real estate ecosystem, traditionally trades with very little correlation to traditional risk assets, right? So as a diversifier in a portfolio, as a complement to other elements of advantage yield that potentially have more kind of, let's call it risk beta. It's a sector that really moves to the beat of its own drum and offers some great non-correlation. So again, advantage yield, low duration, extremely low correlation to risk assets, is the macro thesis or macro value proposition that someone gets within this space. 2 seconds on Semper. We're a US-based asset management platform. We manage about 2.4 billion of assets. Everything we do is in some form of dedicated mortgage strategy, right? We have continue to live in a thesis that being a specialist in this particular sector allows us to add incremental value on top of what is a fundamentally thematically strong opportunity set. We're privately owned. Everything you'd expect to see from a culture, ethics, and alignment of interest perspective is in place. We've been managing mortgage securities since 1992, so coming on almost 30 years of direct experience managing institutional assets in this space. We're 17 full-time, and the short rub on the firm is, while we are very much a boutique, human capital, investment skill set, technology, infrastructure, etc., is all on par to compete with the PIMCOs, the BlackRocks, the 24s, the GAMs of the world. Of the 2.4 billion today, about 600 million is managed for large institutions. The other 1.8 is managed either in U.S. mutual fund format or in UCITS format. Next page, Bob. The next few slides, and we won't go through them in excruciating detail, and certainly all of this information or follow-on conversations are available, just kind of sets the stage for what is the U.S. mortgage-backed securities market. Again, we are very much a specialist in this field. For folks who are looking to use this sector as a complement or a portion of their portfolio, we obviously are strong believers in the value prop. For folks who are looking for general opportunistic fixed income exposure, we're not the manager, right? We do one thing, we do it exceptionally well, and that is parlay our skill set in this space. This chart just outlines there really are two camps in the U.S. mortgage-backed securities market. There's agency mortgages, right? These are, both are pooled baskets of underlying U.S. residential home loans. Agency mortgages, roughly 7 trillion of opportunity set, right? The collateral, the loans are explicitly backed by the U.S. government. So investing in agency mortgages, one is taking advantage of or making money through betting on interest rates, prepayment speeds. There is not a credit component to the opportunity set. The top of the chart, both the light blue and the dark blue, what is called non-agency, these are private label pools of, again, U.S. home loans where the investor is taking their pro rata slice of exposure to the underlying credit dynamics of that borrower. Effectively, we are making, or the market is making, tens of thousands, hundreds of thousands of micro credit bets. Is Bo going to pay his mortgage or not? If Bo is not going to pay his mortgage, when will he default? What will that loan be worth? What can it be monetized at? And it all trickles into the value of the bond, right? So agency, $7 trillion of opportunity. Today, we don't believe there's a lot of compelling value, but at certain points in the economic cycle, a lot of opportunity set. Non-agency, roughly 550 billion of opportunity, where again, you are taking exposure to the underlying credit of the U.S. homeowner. Next page. Again, right, just one of the attractive features, when we think about why we like mortgages, this chart outlines some of the various large subsectors, right? On one hand, there's kind of continuity of investment thesis of investment bet. This product, this sector is giving one direct exposure to the U.S. real estate ecosystem, period, right? You are accessing the cash flows and the principal value of the underlying home loans, right? The collateral they're tied to. So you are exposed to home prices, rates, all of the various elements of value within the real estate ecosystem. So very common, simplistic thesis in terms of where there's value being created. That being said, one of the things that makes this sector disproportionately attractive is the heterogeneity of the underlying assets, the fragmentation of the space, and the ability to tease out value through understanding the differences in slight modifications of both collateral and structure. Some of the larger subsectors that we play in this chart represents are obviously the legacy market, right? These are bonds, bonds and home loans issued pre the first financial crisis, right? So these are highly tenured, assets from 2003, 4, 5, 6, 7, right? That have got 10, 15, coming on almost 20 years of payment history, right? That market today, roughly 250 billion of opportunity. And the 3 or 4 stacked colors on top of that, which we call next generation, right? Loans and bonds that have been originated post 2008, much higher underwriting standards, much tighter control on credit, but new ways to access, again, new structures to allow borrowers to access the market and for investors to access the opportunity set. Next page. Again, just from a framing or an education standpoint, I mean, the big takeaway on this slide is there are a number of different subsectors that are all playing the same top line thematic story, but understanding how, the actual intricacies of the structure, the intricacies of the collateral, they all take on a unique life cycle relative to them as investment vehicles, right? All the sectors range between 15 to $50 billion in value, which relative to, again, Semper plays in our sweet spot. And one thing I should have mentioned, with $2.5 billion of assets at the firm level, certainly we are institutional and can access all of the opportunity in the market. But this is a space that lends itself to active management and being able to drive incremental value through finding opportunity in this opaque over-the-counter market. So this is one of the few areas of fixed income where our size is a distinct advantage. And so when you think about that relative to exposure to various subsectors, right, markets that are 15, 20, 30, 40 billion are certainly perfectly situated for us to take full advantage of the opportunity, where you can imagine the PIMCOs, the BlackRocks, the GAMs of the world, as an example, right? If the single family rental market, right, which is the 5th or 6th line down, is 25 billion in totality, right? From a risk perspective, from a management perspective, you're a larger manager. That's the size of the overall market will be a constraint to how much access you want. With 2.5 billion at the firm level, obviously no constraints in terms of where we go and where we see opportunity. Actually turns into being an advantage in that we can really take advantage of our theses and opportunities that we see. Next slide. Again, just a quick, more detail, lots on the page, but kind of shows the range of credit of the underlying borrower. I mean, the big takeaway from this particular slide is if you think back to what still exists 10 years later, I call it the mortgage shiver, right? The state of U.S. housing leading into the first mortgage crisis, 2005, 6, 7, 8, a very different credit backdrop, right? You had, frankly, poor underwriting standards. You had very little home equity in the properties, and you had a lot of leverage in the system, which built the bubble that then burst in 2008. If you fast forward to today and you deconstruct and you look at the underlying borrowers that backstop the market, extremely high credit quality, right? FICO scores ranging, on average 700 plus. Obviously, the securities have been tranched, so wide swaths of opportunity to play at the senior level, down to the investment grade, down into the mezzanine subordinate tranches. There's fixed rate opportunities, there's floating rate opportunities, but extremely high loan to value, extremely high home equity in the underlying properties. Again, anecdotally for context, in our UCITS portfolio, roughly 400 positions, roughly 450 to $500,000 underlying home loans. Average home equity in the loans backstopping our portfolio is 35 to 40%, right? So a very strong credit backdrop supporting what is a very fragmented sector that allows you really to cherry pick where you want to express an investment opinion or drive opportunity. Next slide, Bo. You know, and I've talked a lot, you know, about the market, right? Again, at the highest level, we believe this sector and our product is giving an investor liquid exposure, right, in a product that has daily liquidity to a diversified basket of securities that are all tied to effectively the U.S. real estate ecosystem. And obviously, our sector and our fund went through a pretty massive technical dislocation last March, right, when Corona morphed into a kind of global risk off. You know, our market, as other risk assets, had some short-term, pretty violent price corrections. But what we've seen post that, right, as the U.S. and the world have navigated through the post-pandemic period, U.S. housing has been and continues to be one of the strongest elements of the U.S. economy. Hard stop, right? Home prices in the States have appreciated 10% year over year. Home equity is at record levels in the U.S. The tools and techniques that the government and the private market use to facilitate and enhance the borrowers that were most directly impacted by Corona were put in place. They were utilized effectively. They continue to be utilized effectively and have been a net positive to the underlying market. And from a top-down perspective, rates remain at historic lows, making home affordability in lieu of or in spite of extreme dramatic movement in home prices. Home affordability in the States is still extremely attractive. So from a top-down perspective, the real estate ecosystem is extremely robust, and everyone's expectation is that continues. And then, frankly, as important, if not more importantly, from a bottoms-up perspective, borrowers have continued to perform over the last 12 months. There are a number of metrics. Again, our skill set is going down to the loan level, understanding, again, is Bo and the hundreds of thousands of Bos in the world going to pay his mortgage or not? If not, what would the disposition of that loan be? How long, how much, et cetera? And every metric that we track that illustrates the health of the borrower has continued to improve over the course of the last 12 months. Severities, defaults, delinquencies, prepayment speeds, all of the underlying metrics that act as individual signposts on the health of the borrower has remained, not only has remained strong, but has actually improved in light of or in spite of the ongoing effects of Corona. So that all boils into, on a go forward basis, right, from a credit perspective, we think that, again, mortgage-backed securities offers access to the strong, one of, again, if not the strongest credit profiles in the U.S. In a space that, due to its complexity, its fragmentation, its opacity, can drive extremely advantaged returns. Next slide, Bo. I mentioned, on top of that strong yield value component, the rate sensitivity. What this chart outlines, right, the large black line that goes up to the right, dramatic drop, and then back up to the right, that's the performance of our strategy, right? Again, what you've seen since we launched it in 2013 is pretty consistent, stable, upward trending performance. Very violent one-off downdraft in the midst of Corona, March 15th to April 5th. The entirety of that downdraft was at 3 weeks of uncertainty around Corona. And basically, like on a button, strong recovery once the market had delevered. The areas in the bottom right chart, the one in you can see, or the chart that kind of goes up and down, the light blue on my screen, that's the U.S. 10-year yield, and the shades of gray are periods of rising rates, right? And again, this is just the historical fact pattern for a host of reasons: portfolio composition, nature of the assets. Our asset class and our fund does not trade with historical sensitivity to rates. Most importantly, you see, 2020 into 2021, where the 10-year bottomed at about 0.6 and now is trading about 1.7. If you map that on our performance, right, you do not see what you would expect, that kind of negative correlation of rates to performance in fixed income. So, this is certainly for folks who are thinking about the need for yield, but the traditional sensitivity to worry about rates, an extremely attractive sector and product. Next slide, Bo. Frankly, this chart really, the value prop sums it up, right? I'll draw your attention to the two bar charts at the top. On the left, these are the yields, loss adjusted yields in the portfolio, where that blue box, right? And again, I'll just call out that is actual yield, right? High yield, other fixed income is quoted in nominal yield, not factoring in defaults, right? So we're in market with the yield on this slide at give or take 4. In reality, today the portfolio is probably 4.5 to 5. And then you juxtapose that with the bar chart on the right, which is our duration, right? Mathematical effective duration, our portfolio is 2. Empirically, it trades closer to a half, right? So that combination of advantage yield and low duration is at the highest level, right? The value prop we're in market with. Next slide, Bo. Certainly of interest in the States. It's something we take a lot of pride on. Just comment, right? We are very ESG focused. Certainly internally, we are both a minority and a veteran-owned platform that has a strong standing commitment to give back to the community, which we live into every day. And when it comes to how we invest, right, structured credit, not traditionally been a place where ESG is factored into the decision process, but we're frankly on the leading edge in helping the market think about how to look at structured credit cash flows and apply an ESG lens, whether it's environment in terms of geographies of where the loans are originated, social considerations, who are the borrowing base, governance in terms of the servicers' activities, and ensuring that we can continue to push the envelope relative to having structured credit think about ESG and continue to drive an advantage performance profile. Next slide. We'll just go one more. I know I'll try to get questions, but look, this is at the highest level a snapshot of the portfolio. Quick metrics just for folks in the UK. Strategy is 1.4 billion today, about 1.5 billion. In the UK, we're running circa 300 million USD. We're coming on our 3-year mark. Loss adjusted yields, folks should expect, this is all pre-hedge, 4 to 4.5%, a duration of 2. And as we continue to recover the dislocation from last March, folks should think about this on a total return basis of, an 8 to 10% total return coming over the next 10 months. Next slide. Again, as folks think about, again, summary slide, again, this just illustrates, right? Certainly on one hand, at a top-down perspective, this fund has a very clean investment bet. It is direct exposure to U.S. non-agency mortgages, period. That being said, underlying that portfolio is a lot of diversification. Diversification by collateral type, diversification by vintage, diversification by subsector, right? And all of these individual sectors have unique kind of bells and whistles around the structure of the collateral, where they trade slightly differently. They give you exposure to different toggle points in the real estate life cycle. So while all tied to the same macroeconomic drivers of housing, they all have very unique characteristics that allow folks like us to provide diversification across a number of different levels, but also tease out value and really cherry pick the best opportunities at a subsector level. Next page. This is just representative of a performance chart that's been cut post dislocation. Again, if you looked at the history of this, history of our fund, right, from launch in 2013 up until March of last year, this was the 5 to 6% net, kind of puts you to sleep through consistency of return stream, right? This was a good month, 60 basis points, a bad month, 40 basis points, average month, 50 basis points. Between the time period between March 15 and like April 5th, our market suffered a pretty severe technical dislocation. A host of reasons, happy to go deeper on them. We have had the standing thesis that was technical in nature. It was not credit impairment. And that as soon as the market stabilized, you would see recovery. And what you've seen since April of last year is that recovery being put in place, which will continue, right? There is roughly 6 to 7 points of incremental price appreciation left in this particular product, which we believe is a function of technical dislocation, right? So 0 concerns with the credit. What was proven over the last year was we didn't suffer, our sector and our fund did not suffer any credit losses. The price dislocation was purely technical, and we have recaptured roughly 70% of that. and fully expect that over the coming 6, 9, 12 months, we will capture the entirety of it. So again, for a new go-forward investor, there's the opportunity to take advantage of this standing, loss adjusted yield 4.5%, but also from a tactical perspective, capture an additional 5, 6, 7 points of return opportunity over the next 10 months, just as that technical dislocation is squeezed out. Next page. And certainly a lot to walk through. There's a lot of detail, right? We could talk for hours on the complexity of the space, where we're seeing value, how we manage the assets. I'll just leave it at, again, what you're buying, if you're exposed to Semper, is very quantitative, bottoms up, loan level perspective on cash flows, a very bottoms up, intricate deconstruction of the structure. And I position this as highly quantitative, deep value investors in the mortgage space. Welcome the opportunity to start a conversation, start a dialogue. For any of those that on the Zoom that are current clients, we appreciate the support, and you should expect more of the same over the coming 6, 12 months in terms of strong performance. With that, Bo, I'll turn it back to you.
That's great. Thank you very much, Greg. Okay, well, we have a couple of questions for you. You've touched actually on these two main topics, but I think with the amount of coverage they seem to be getting in the wider sort of financial media, something we should certainly talk about. First off is going to be this rising inflation or inflationary pressures. Just any concerns for MBS investors? Anything that you look at in particular in these environments?
No, I mean, well, certainly we look at it, we monitor it, and rates are an input into our loan level credit analytics, right? So certainly we are very cognizant of rates, but our focus is really on how do those rates potentially impact the cash flow payments from borrowers. At a portfolio level, we have zero concern with rates, right? Our expectation is that rates continue to drift north in the States. The combination of assets we have in the portfolio today and the amount of floating rate paper we have today, rising rates is actually a positive for us. We expect to see the yield in our portfolio start to improve or start to increase, right, as rates continue to drift up. And from a bottoms up perspective, rising rates is all really based on confidence and strength and a belief in the underlying strength of the U.S. economy as that trickles into and as that trickles down into housing, right? So if you think back pre-pandemic, the U.S. 10-year was trading about 1.8, 1.9, right? There is no reason that the U.S. shouldn't be drifting back towards that as the U.S. continues to normalize, right? So rising rates are not just not a concern; they're actually a positive with how our portfolio is positioned today.
Okay, great, Greg. And just looking at it, so the duration of the fund is circa 2.2. So how do you achieve that? Is what I'm looking for. With that, you just mentioned that floating rate paper. Can you just expand a little bit, please?
Yeah, I mean, look, I think it's really, two ways. Certainly there is an element of, as we look at individual assets and deconstruct the loans, right? There are assets, loans, and or structures that might have mathematical effective duration, but due to the nature of the asset class, due to where we're playing in the cap structure, actually trade with very little empirical duration, right? A lot of these assets still trading at a discount to par, where they're even quoted and talked about on a yield basis, not on a spread basis, right? So certainly there's an element of just asset selection where your duration is, the duration number that asset might represent isn't actually in sync with how it trades or the value proposition. There's an element of portfolio construction where, look, we are very conscious of ensuring preservation of capital, ensuring the right liquidity profile, right? So certainly at a top-down portfolio perspective, we are conscious of not adding assets that do truly have long duration. And then we're pretty opportunistic with the use of floating rate paper. Today, give or take 50% of the book is in floating rate, right? So again, as a portfolio tool to take duration off the table as a driver of value, you've seen us utilize the allocation of floating rate at a macro level up and down to kind of add or take away duration of the portfolio level. So it's something that is thought about at the asset level, at the thematic level, and at the portfolio level in terms of trying to ensure that we live into that value prop.
Great, thanks, Greg. Obviously, we could keep on going for quite a while now, but I think we've kind of reached our allotted time. What I would say is that, Greg, actually, you'll be on another webinar solely on Semper investing in RMBS for income on the 29th of April. So we'll be following up from this webinar. And if you do wish to attend, please do let us know. Our details are obviously also on the page there. All that really leaves to me, Greg. Thanks for your time today. And that was Stock Tour. And for everybody for joining us, thank you for your time and have a good afternoon.
Great. Everybody stay safe. Thank you for the opportunity.
Cheers, Greg.